We're here to discuss monetary policy and gold mining with our next guest, Tim Smith, who is the CEO of US GoldMining. USGO is the ticker. Welcome to my show, Tim. Pleasure to host you today.
Thank you, David, very much for having me on the show. Delighted to have the opportunity to be able to speak about the gold space and also, of course, to raise awareness with your viewers about our new company, which is called US GoldMining Incorporated, which we just launched recently via an initial public offering, in fact, less than 2 months ago, back in late April. And that is now trading on the NASDAQ exchange under the stock ticker USGO.
Yes, we'll get to the financing aspect of your company. Lots to discuss there, but first, macro news coming out of today. As of this week on June 7th, the Bank of Canada raised their key interest rate to 4.75%, up by 25 basis points. This is the highest level in 22 years. You and I are both based in Canada. Inflation has come down. It's still hotter than the Bank of Canada's 2% inflation target. But the question everybody has on the back of their minds is, why is the Bank of Canada continuing to raise rates, given that down below the border, the U.S. Federal Reserve has indicated that they may pause rate hikes for at least the next meeting?
Yeah, great question. It was interesting to see gold price take a dip today. So obviously the market is starting to factor in what they think is going to happen. I don't believe it's so much in response directly to Canada today, but perhaps what they think that signaled with respect to the US Reserve coming up in the coming weeks. Certainly going back to inflation, I think we've seen some leveling out from the highs that we experienced over the last year or two coming out of COVID. I think here in Canada, it's sitting around about 4.4%. And our shared experience, I think, as consumers, we're all consumers, and we continue to see inflation really out of control. We know how expensive everything is. We all need to put gas in our cars. We need to buy groceries to put on the table for the families. So, I think what we're all interested to know is, when are we going to see it back at around 2% again? Are we going to see that this year? I don't think anyone, I certainly wouldn't be game enough to see, to call that happening in the near term, and that certainly in the next year. I think maybe it might take a couple of years to get back to those levels. In our space, in terms of what that means for the gold price in the short and medium term, with high inflation and that uncertainty that it's going to get any better anytime soon. And clearly that involves some speculation, that the reserve banks will continue to increase interest rates to try to get inflation under control. But all these things, I think are pointing for us in the gold space over the short term is that's going to impact the strength of the dollar, and therefore it will support a movement generally towards gold as a hedge against economic uncertainty, the potential for recession, and subsequently demand for the gold, therefore will support a high price.
So you mentioned there are factors that will support a higher gold price. What are these factors, Tim?
Sure. So, we see a number of factors across the broader economy that is generally pointing towards a high gold price over the longer term. 2023 so far has been very good for the price of gold. In fact, if we go back a little further towards the end of October, early November, since then in 22, we've seen gold up about $300. That's about a 20% increase in the past 6 or 7 months. And, certainly it's been a great time for us to launch a brand new gold copper exploration company. In terms of short through to longer term prospects for gold market, I would actually suggest that in my 27 years in the industry, I don't think I've ever seen a setup that looks quite like it will support a major bull market in the coming months and years for gold in the way that we're seeing it currently. I think we can look at some other commentators, certainly much more preeminent commentators than myself. We look at somebody like Pierre Lassonde, of course, founder of Franco-Nevada, and some would say the father of the gold royalties and streaming. He's been quoted over the last year as saying that gold will hit $2,400 over the medium term. And when he said that, he was really talking about 2023. And over the next 5 years, he was quoted as saying it could hit anywhere up to $10,000 and as much as $25,000 over the next 30 years. This is one of the big names in the gold industry. Of course, we can look at factors such as geopolitical tension. Obviously around the world, which means that gold as a safe haven and a store of value will have moments where we will see those spikes in price. We've seen the spikes before. First, most recently when Russia invaded Ukraine, and of course at the start of the COVID pandemic. And there are additional geopolitical issues occurring currently around the world, such as the China-Taiwan and the political situation in some other countries. You can look at the subcontinent around Pakistan and also South America, such as Brazil, Chile, and Peru.
So do you agree with Mr. Lassonde that $2,400 an ounce is likely by the end of the year?
I certainly think we're going to see a 2 in front of the number more than a 1. So, we've seen gold trading at around 2,000 plus or minus $50, I think, for about the last two months now. Certainly, since the regional banking crisis in the United States that started around early April, we saw gold shoot up to close to an all-time high, and it's really stayed close to that level. As I say, it seems to be building a new base at around 2,000. Certainly, there are short-term fluctuations that are going to affect it from day to day, but I think the longer term is that we're going to see plenty of support in terms of the price building. And one of the other things we can look at is the demand for gold. Certainly, we're seeing that there is a lot more buying by the central banks. We can look at the BRICS countries, for example, but this is also widely reported globally that there are various economies that are looking to move away and perhaps support their economy less from previous traditional reliance on the US dollar as perhaps the default global reserve currency, but starting to put gold into their vaults to support their economies. The World Gold Council, for example, recently reported there's been an increase in demand for gold by central banks every quarter since at least the start of last year, and that included a 228% increase in Q1 of this year. So we'll look forward to see what the Q2 numbers look like shortly. And this is the highest amount of central bank buying since the 1950s, and I think it's interesting because not only is it indicating that those large developing economies have a strategy to build their own reserves, and as I say, move away from their reliance on the US dollar as a form of global reserve currency, but also perhaps points to a weakening of the US dollar over time. And also clearly, this is going to be driving up the demand for physical gold.
Why do you think that central banks have gone on a gold shopping spree last year? Like you said, the highest amount of gold bought by central banks worldwide, according to World Gold Council.
Well, as I say, they're really starting to move away from their reliance on the US. I think BRICS countries in particular, the Brazil, Russia, India, and China and so on, are really looking at developing an alternative in terms of being tied to the US dollar as they have in the past. We're seeing the petrodollar, for example, is starting to be challenged. And I think generally these countries, they have their long-term, models of independence away from the US dollar. So as a general impact on the gold price, softening of the US dollar will tend to, it will create weakness that will tend to support the gold price as the market moves towards gold as a long-term stable store of value as a hedge against those fluctuations.
Gold investors would like to understand whether or not this current gold price is conducive to M&A activity. Now, I'm looking at a report from S&P Global Market Intelligence, and this is a report reviewing M&A activity in 2022. And this is a review of all commodities, not just gold, but copper and zinc, so a lot of the key metals. Overall, in the commodities space, they reported that there's been 56 total major deals in 2022, which is a roughly 12% decline in the total deal value year over year. This is in light of declining macroeconomic conditions last year and, of course, a decline in the risk assets, including stocks and cryptocurrencies. Now, interestingly, gold actually fell slightly year on year over last year as well. So, but clearly that didn't stop M&A activity, even though we had a slight pullback in the gold price. So I'm guessing, just correct me if I'm wrong, but I'm guessing that the seniors in particular care more about the absolute level of the gold price rather than the direction.
Uh, I would agree with that, but I think there's a bigger factor at play for the seniors that is driving their M&A activity, and that is simply that the reserves in the ground are reducing. The majors need to sustain their production, but we're clearly not seeing that in the data. And in fact, what we're seeing. And in fact, we did some research on this because we wanted to really understand this. And what we saw is that from a basket of the largest gold mining companies around the world, that their reserves and resources in the ground over the last 10 years have reduced by almost 50%. In other words, the biggest gold mining companies are not replacing their mined ounces via exploration, which is traditionally how they would have done that over the last 50 years. We saw major discovery booms through the 70s, 80s, 90s, into the early 2000s. We're not seeing that. We haven't seen that since 2010s. Discoveries are becoming harder to come by. Those producers still need to sustain their production. So how do they do that? They're doing it via acquisition. And they're having to do that via an increasingly smaller and smaller supply of large, high-quality deposits in safe jurisdictions where they're comfortable with the risk profile. And, I would include our Whistler asset in that. We think Whistler, and we'll get to this, is an asset that the big gold mining companies will want to own as part of their project development portfolio in the longer term.
Now, you've worked at Goldcorp and then Newmont following the merger. If you were at the leadership team of a large senior company like Newmont, you've mentioned that a lot of them are focused on acquisitions. Would you prioritize acquisitions right now over, let's say, brownfield or even greenfield exploration?
That's exactly what they're doing. And yes, I just spent the last 6 years before coming to work for US GoldMining Inc. I worked for two of the majors. First up, I spent 3 years at Goldcorp. Newmont then acquired Goldcorp, and so I joined Newmont, which, by the way, is the world's biggest gold miner. And so I know this from firsthand experience that the only way companies like Newmont can continue to sustain their current levels of gold production is from acquisitions. I was the head of generative gold exploration for Newmont in North America, and I can tell you that they're not exploring to the levels that are going to supply that or sustain that production organically. And of course, the issue that you have in the discovery space is that the average time period from discovery through to production is 20 years. So they need to look much shorter in terms of the time focus. They need to bring advanced projects on, and that's really what they're doing. We saw them acquire clearly Goldcorp in 2019, as I mentioned. There's been a number of other acquisitions and partnerships along the way, and of course, most recently, we're seeing Newmont now closing out a deal with Newcrest for $19 billion, and I think one of the reasons not only will that acquisition obviously increase their annual production, but Newcrest had a great portfolio pipeline of advanced development projects that I'm pretty sure Newmont wanted in their own project portfolio.
You're absolutely right. They're focused on acquisition. I'm just curious as to understanding the economics behind that particular decision. With gold price near its all-time highs, and like you've mentioned, we can expect gold to go even higher for a host of macroeconomic reasons. Would it not be more economically, I guess, feasible or viable to invest in exploration rather than buying a company when the gold price is near an all-time high? Presumably the NAV would be higher.
Well, certainly we see exploration costs traditionally of around, say, $5 to $10 per ounce. And yes, it would be much cheaper if discoveries were guaranteed. But unfortunately, exploration is not guaranteed. There is natural geologic risk. And I mentioned the time factor also. So if you were to make a discovery, it might take you 20 years to delineate undertake the feasibility studies, the environmental baseline studies, and the permitting before you're ready to get that project through ultimately to construction and those ounces come online. They are starting, to obviously look out to 25, 50-year forecasts in terms of their portfolio. And what they're seeing, the majors I'm talking about here, what they're typically seeing when they look at that, as they look at the assets that they currently own and the natural projected depletion of those assets, obviously the delta there is what they need to discover. And when they apply the risk factor of exploration, it simply makes sense to hedge against the potential for exploration not being successful and to acquire ounces as well. So it's not to say that the majors are not exploring, but they certainly need to acquire ounces to ensure the certainty of their production profile going forwards.
Tim, you're a geologist by background, so I think you're well positioned to answer the next question. Have we reached peak gold, meaning the maximum yearly production volume of gold? Has that been achieved or reached already?
Great question, because we've actually seen it go up, production go up over the last couple of years. So certainly as a number of big mines and general efficiencies in the mining industry have come on stream, we have, as a global industry, been able to increase production. That would tend to put downward pressure on the gold price. So I think, what we're looking at is longer term. Simply, you have to read the numbers, and the reserves and the resources are not going to sustain either increased production or even production at the current levels. Geologically, in terms of peak production, certainly discoveries are becoming harder to come by. They're getting deeper, they're getting lower grade. Certainly the ESG factor is starting to weigh in, the societal implications of making the discovery, and then looking essentially for social acceptance from the local community wherever you are. The gold industry has certainly been working hard at cleaning up its image over the last 10 to 20 years, really bringing in sustainability as a core value to make sure that the broader public and all stakeholders understand that gold mining can be completed sustainably, and it's certainly a far better solution to optimize the realization of that value in the ground via the alternative, which is artisanal and oftentimes in a lot of jurisdictions around the world illegal mining practices that really don't pay any heed to sustainability, either short or long-term environmental harm.
I'd like to lead into the projects that U.S. GoldMining currently has in the developments, but by talking about this next question, which is how you would pick, as a geologist, pick jurisdictions to do exploration in. Suppose you had a blank canvas, you were advising a company, a startup, a junior miner who hasn't launched anything yet, and they asked you, Tim, where should I go? Anywhere in the world? Which belt, which jurisdiction I should operate in. You have to factor in a number of things, obviously. So the feasibility of the project, jurisdictional risk, geopolitical risk, the economic feasibility of being there, the grade, factoring all these decisions in. What are some of the most important criteria that you would first evaluate?
Well, certainly as a geologist, seeing as you started with that, my first inclination would be to look at the geologic prospectivity. And then I would look to look for areas that are underexplored. So certainly geologic prospectivity as the first factor, that tends to take you to parts of the map, the global geologic map, where mining is already well established. It takes you to places like the Timmins Belt, for example, or the Carlin in Nevada as some of the biggest gold producing sectors. But you want to, as I say, temper that against areas that are, in fact, underexplored, because that is where the opportunity lays. I think you want to look at fairly remote jurisdictions. And then simply because, we know that it's very difficult to explore or to ever build a mine and anywhere that has a high density of population. And then thirdly, I think you want to look to stability in terms of political and legislative stability. And if you can add to that incentives that the particular regulators and political leadership in those jurisdictions are bringing to bear, and oftentimes you will see tax breaks, you will see mining infrastructure programs underway, and other incentives to bring mining investment in, because jurisdictions know that mines pay millions and millions of dollars annually in royalties and other tax benefits that feed back into the local economy. They employ significant numbers, and they grow the overall skill set of the local population. And of course, there's a significant downstream benefit to the economy as well. So certainly, we love the Americas. Our parent company, GoldMining, set about building a portfolio of projects within the Americas. And in particular, our asset Whistler, which is in Alaska, we think is a fantastic jurisdiction. It has slipped a little bit, most recently in the Fraser Institute's rankings. Last year, it was ranked in the top 5 for both geopolitical and investment incentives, but also for geological potential. I think it's still certainly in the top 20. It's slipped down to about 11, I think, in terms of investment attractiveness. There have been some well-publicized issues in Alaska, in particular with the Pebble mine, that I'm sure many of your viewers would be familiar with. But once you get to the jurisdictional level, there are things that you can look for, and in particular, you want to be close to infrastructure, and you want to be on stable land where there is a clear path through exploration permitting right through to mine permitting. And we believe we have that at the Whistler project.
Right. So let's talk about what the Whistler project in a little bit more detail.
Sure.
How does the Whistler project fit all the criteria that you've just given? Can you please give us some details and examples? Yeah.
Yeah, happy to. So our main asset, our flagship asset within US GoldMining Inc. is the Whistler Gold Copper Project. It's located 100 miles northwest of Anchorage. So that makes it the closest large undeveloped project to the certainly the state economic and population capital of Anchorage. We think Whistler is a unique opportunity for investors in both gold and copper, in terms of its size, quality, and, as I just mentioned, its location. So obviously it contains both gold and copper. We can combine that into gold equivalent just to give some key takeaway metrics. It's around 9.4 million gold equivalent ounces total. So significant size. And we can break that down in terms of comprising 3 million gold equivalent ounces in the high confidence indicated category, and another 6.4 million gold equivalent ounces classified as inferred. In terms of the commodity breakdown, it's about 70% gold by value, almost 30% copper, and a little bit of silver. So it certainly offers great exposure for investors in diversified commodities, and with the copper component, investors who are interested in the critical metal space. And there's about 1.1 billion pounds of copper in the deposit, 400,000 pounds in the indicated category, and another 700,000 in the inferred category. So that's a substantial copper deposit. Sorry, David. Yeah.
No, please continue. Sorry.
Oh, look, no problem. I'll just round out. Assets of this scale in mining friendly jurisdictions and topographically mining amenable locations. I think a lot of people think of Alaska as being glaciers and polar bears, but in the south of Alaska, close to Anchorage, we're in the foothills of the Alaska Range, 100 miles clear shot across a broad alluvial valley. Assets like this are becoming increasingly scarce, and we think they're on the radar for future acquisition by the major gold and copper producers in our sector for all the reasons I gave earlier, in terms of the reducing reserves and resources that we see in the major gold company future development portfolios. So our thesis is, with the gold mining industry struggling to replace its production via new discoveries, that assets with the size and quality such as Whistler will be acquired ultimately by the major gold copper producers.
So that is your long-term plan to strive for acquisition. I've always wondered when speaking to juniors why it is that juniors haven't just invested in the infrastructure to do the drilling themselves. I know they're two completely separate professions, if you want to call it that, but you've had the experience of working for large producers, so you certainly came from a team that has a know-how. Have you considered just making the CapEx investment to do the drilling yourself?
Well, I'd stress that one possible exit strategy for our investors is some kind of transaction with the major. It could be a partnership, and certainly we could go it alone. My experience base, I have 27 years in the gold industry. I've worked from the juniors through mid-tiers and majors. I've worked from greenfields gold deposit discovery right through to underground mine production. And I've been on 3 projects in the past that have gone through discovery through to mining. My colleague and co-founder and chairman of US GoldMining Inc., Alistair Still, is another veteran gold executive who's worked primarily for the majors, and he has built large mines in the past. He moved his family down to Argentina to build the high-grade Cerro Negro mine for Goldcorp about 15 years ago, which obviously is now one of the shining stars in the Newmont portfolio. So certainly we can do that, and we won't shy away from doing that. And we will be doing the drilling ourselves. We will certainly be undertaking all of the steps, whether we mine it ourselves ultimately, or whether it becomes a compelling acquisition target for another company. The work that we need to do is the same work. We need to drill it. We need to expand it and grow the resource. We need to define it to the highest confidence classifications. Ultimately, in order to produce a reserve, we need to undertake the additional mine engineering studies, the environmental studies, all of the work with respect to permitting to build social license and put it on a clear line of sight through to ultimate project permitting. And whether or not our name is on the permit or some acquirer comes along and sees value in owning Whistler, we undertake the same work now. And Alistair and I know exactly what needs to be done. We've done it before. We've delivered on value in the ground and in terms of a return on shareholder investment.
So your aspiration isn't to become like another Goldcorp, for example, start with the exploration and eventually produce it yourself and become a very large producer worldwide?
Never say never. Big companies started out as small companies with great assets. So, as we start to put the drills onto the Whistler project later this summer, our minds are open. Depending on what we get in the ground, we can certainly see some really exciting short-term wingspan opportunities to grow the existing deposits. I talked about the 9.4 million ounces there. I think we can grow that. I wouldn't want to put a number on it, but I think we can grow that significantly. And not only that, we see some really high value opportunities in terms of a core of high grade that sits within those deposits. So if we can expand and get better delineation in our geologic models, we will see an increase in grade and an increase in metal in the ground. Add to that, I mentioned the fact I've made discoveries in the past. I was VP exploration, for example, for Kaminak Goldcorp. We discovered the 3 million ounce Coffee Gold project in Yukon. I did that back in 2010. We ultimately sold that company for 520 million Canadian to Goldcorp in 2016. So we took it from discovery through preliminary economic analysis and then to feasibility, at which point the exit opportunity was clear for our shareholders, and we completed that transaction. But we know the steps that we need to take in order to grow the valuation and ultimately return on a compelling mining scenario at the Whistler gold copper project.
In terms of your relationship with U.S. or with your parent company, GoldMining, now U.S. Gold Corp or U.S. Gold Mining rather, USGO has recently listed on the NASDAQ, I believe,
That's right.
as of April. So just for the investors watching this to understand, have you divested from the parent company? Or are you still affiliated? What's the relationship here?
No, we're still affiliated. The parent company still owns around 80% of the stock. So essentially, the asset was acquired by the parent company, GoldMining Inc., in 2015, and they shelved the asset while we waited for the right time, and the right time turned out to be right now, with gold and copper showing strong growth over the last few years, and there are some additional catalysts, as well, currently underway. One is that the government, the state government, under Governor Dunleavy in Alaska, is putting money into the design and also the permitting and ultimately the building of a road that will connect Anchorage with Whistler. So that will essentially, we think, follow a model similar to the Red Dog mine, which is a large zinc mine owned by Teck up in the north of Alaska, where the state designed and built that road, which significantly reduced the upfront capital cost to that particular mine development opportunity, which was subsequently repaid back over time via a toll facility. So we think we might see a similar model with that. Certainly the opportunity to have a road built directly to Whistler, which will allow us to bring equipment and consumables into Whistler and ultimately truck concentrate out to port. And by the way, at the end of that road, at a port facility just near Anchorage, there's a ready-made built and waiting port, underutilized, and this is one of the reasons why the government is really investing in this key piece of mining infrastructure.
Okay, so I'm looking at your balance sheet here. For the last part of our discussion, I'd like to understand your financials. So pre-IPO, you have, as of February 28th, your balance sheet showed about $112,000 in cash. Has that, first of all, has that cash balance position changed since the IPO?
Oh, absolutely. It's changed very significantly. So as part of the IPO process, we announced closing of a financing of US $20 million. The proceeds of that after commissions and expenses was expected to be around 18.6 million. That closed on April 24th. So we have had around six to 7 weeks now where we've started to launch the company. We've put teams into the field to start building and renovating the camp there in order to bring drills in. So we are executing on our program as outlined within our prospectus in terms of the use of proceeds. So we'll look to our Q2 financials, which are closing in the short term here. So there will be obviously a Q2 financial report coming out at the end of the month that will update the market on that cash position. But it'll be 20 million. Minus expenses over that part of Q2 since the financing was closed on April 24th.
Okay, and I noticed under liabilities you have 1.5 million in payable to GoldMining, the parent company. Can you comment on that and whether or not that's a priority for your financing to be paid off?
Yeah, certainly. So that financing allowed us to go through the process of putting together the reports, the technical reports, and the prospectus, obviously, and then undertaking the IPO itself, which was a process that took about 12 months. So certainly there is an expectation that gets paid back. There is a plan to do that, and we'll be reporting on that as part of our quarterly report, Q2 quarterly report coming up.
And under current macroeconomic conditions, would you generally prefer to issue equity or debt? Is it even possible to issue debt at this point?
Well, there's always debt facilities out there, but right now, we don't need to issue any equity or debt. We're cashed up for the next two years here, and we expect to have adequate treasury at the end of that 2-year period. So, the use of proceeds that we outlined in the prospectus as part of the IPO and the financing attached with that is that we will undertake a 2-year field program, including drilling. We just talked about that in our news release last week. So we're going to be drilling at least 10,000 meters of core, which will be focused on exploration and also delineation of the gold copper resources and reserves at the Whistler project. We will be adding to that mine engineering studies, and also environmental baseline studies and other stakeholder consultation programs in order to build out the first preliminary economic assessment on Whistler, which we aim to commence in the latter part of 2024. So, in other words, the first mining concept or mine scoping concept study by the end of 2024 on the back of that investment.
Okay, so can investors expect you to execute on, I guess, the delivery of your project and the discovery plans for the next 3 to 5 years without taking on additional fundraising? Is that what you're saying?
Certainly, over the next 2 to 3 years, that would be correct. And once we hit the next milestone of producing that PEA, we will be able to reassess the next steps in terms of going on. We believe at that time we will want to go move directly into feasibility, at which time we will look at the financing required around supporting that. But we think we're going to see a significant valuation hike. Our market cap has already gone up significantly since IPO. It's been extremely successful. We launched at around $10. We're trading between about $14.50 and $15 over the last few days. With 20 million in the bank and a 170 to 180 million market cap, if we pull that cash out, the enterprise value of that 9.4 million ounces in the ground is sitting at around $16 to $17 per ounce, and that's still significantly lower than the global median for equivalent staged projects, which is around $40 to $50 an ounce. So there's a big delta there. And obviously, the work program that we've designed, as I just described, the drilling programs to delineate and explore and increase the value of Whistler, we believe will get us to that $40 to $50 per ounce. So we'll be in a significantly stronger market cap position by the end of the next 2 years.
Just to illustrate that in enterprise value terms, what is the total value, the net asset value of the project at Whistler, and has that been fully priced in to the stock value, which is about $15 a share right now?
When we priced the IPO, we priced it at $100 million. So what we're seeing now is essentially the market recognition of the delta between $10 per ounce. So that 100 million valuation priced our per ounce enterprise value at $10 per ounce, and the market is recognizing the delta between that and the average when we look at comparables across the sector of $40 to $50 per ounce.
Typically, what is the acquisition premium on a project?
Well, great question. It depends obviously on the stage that it is acquired, and we've seen some very high premiums on even some pre-resource projects in the recent past with Kinross acquiring Great Bear, for example, which was pre-resource for $1.5 billion. So that's a bit of an outlier, but certainly it's not unusual to see projects by the time they get to feasibility study trading in the range of $100 per ounce. That's the sort of median for projects that look like they have a clear line of sight through to mine production and they're getting ready to go into project financing. And, I mentioned an example from my past earlier when I was VP Exploration for Kaminak Resources, at which point we had we'd made the discovery in 2010. By 2016, we had delivered on a feasibility study, a very compelling feasibility study, and Goldcorp acquired that project for its development pipeline for Canadian $520 million, and that equated to $130 US, by the way, $130 per ounce for the ounces in the ground there. So lots of examples where we see larger companies paying well over $100 per ounce for quality ounces in quality jurisdictions.
Interesting. And typically, when you conduct a deal, I mean, this is a generalization. I'm just curious as to what the gold price assumption is when you factor in the gold price in your model. Is it the current spot price, or do you do a forward assumption, or do you do like a premium to the seniors' cost of production? What's usually the gold price assumption here?
Certainly, typically a premium to the senior gold producers because they're generally very conservative. But we will take a consensus approach. Currently, reserve pricing, for example, at Newmont is around $1,200 or $1,300. Our input resources were calculated at $1,600 gold and $3.25 copper. When we get to the point where we're ready to start building out an economic model this time next year on Whistler, we will take a look at the trailing averages and what the consensus pricing is across the industry for equivalent projects at equivalent development stage, and we will take a view on that.
So just to clarify, you're saying that the $150 or $173 million in market cap right now is based on a $1,600 gold price assumption?
Correct.
Okay. So really it should be worth higher because of if you factor in current spot prices.
If you factor in spot price, that's right. But, I think it's general, as I say, we look at consensus pricing and the market typically as a consensus will factor in some conservatism there in terms of potential for fluctuations in the commodity pricing over the life of mine of the asset that they're modeling.
All right, Tim, thank you very much for your time. I'm just curious as to final closing thoughts. You've had a very long career in the mining industry. How, for the future geologists watching the show and engineers who are in engineering school right now, what is the career transition path from working as a geologist in the field to an executive member in the C-suite?
Well, I think it's getting stuck in and not being afraid to get out in the field early on in your career to really understand the fundamentals of the business. Certainly, you can spend your career these days behind a computer screen modeling, but if you haven't been in the field, you don't understand really how the rocks and the ore deposits work. You don't understand how the business works itself. You really need that grounding in terms of core experience. And then, I think you need to get around and see a number of different deposits. I've been lucky enough to work all over Australia. I've been lucky enough to work with some of the biggest companies all over North America and visit and in fact work in a lot of countries in South America now. So I think having that exposure to a number of different ore deposit styles, a number of different jurisdictions, a number of different business models in terms of how to actually seek value, whether it's exploration for a brand new deposit or whether it's refining and finding the efficiencies in a currently operating mine site. I think you just need time and experience and be prepared to go wherever they send you.
What, as a geologist, what tools and new technologies would you want to see being delivered in the field to, I guess, increase efficiency or make the geologist's life a little bit easier?
Yeah, there's some exciting new advancements over the last 5 to 10 years in terms of handheld geochemical measurement as I say, in the field. Traditionally, you had to send your samples off to the lab, but we're starting to see portable XRF that can give you real-time geochemical values, and we're also starting to see small portable spectral devices that can really help with the mineralogy of some of the more invisible minerals, the very fine-grained cryptic minerals that are hard to see in the ground mass, but which are key minerals, in terms of understanding, for example, in the porphyry space, exactly where you are with respect to that overall porphyry system, and that having that understanding really helps you vector into where the high grade mineralization is much quicker, reduces the overall time and amount, and therefore cost of drilling required to get to the core of that system, the high grade core, faster.
Interesting. Any way that AI can improve exploration?
Oh, absolutely. I don't see why not. I mean, AI has been used now for many years in the exploration industry in terms of being able to assimilate massive amounts of data much quicker than we can. We are often overloaded by the amount of data that we have acquired. If you look at some of the larger historic mining centers in places like Canada and the United States, for example, there can be 100 years of data. A human can really only visualize a small part of that at any one time. And, AI can assimilate and search for patterns in that data so much more quickly and arrive at potential conclusions. Certainly interface with actual humans is going to continue to be important in order to vet that and ensure that the multiple lines of evidence that the AI might be outputting actually makes some geologic sense. But I can certainly see it becoming used more and more frequently and widely in the industry in the coming years.
Might be a while before we see robots doing the drilling, though, hey?
Maybe. There's certainly a big push towards automation, mechanization of the drills as well.
All right. Well, that'll be an interesting site. But for now, thank you very much for your time. You've been very informative for educating us about not only your company, but about the industry. So thank you for being here.
Thanks so much for your time, David. Happy to come back anytime.
Great. And thank you for watching. Stay tuned for more, and don't forget to subscribe.